Welcome back to the Deep Dive. We're here to give you the essential knowledge, straight up, no noise. And today we're tackling a question that's less about optimism and, well, more about essential risk management. What actually happens across the crypto market if the big one, Bitcoin, suffers a really systemic collapse? Anyone holding altcoins, thinking ETH or XRP, that kind of thing, really needs to confront this possibility. If Bitcoin were to, say, crash 50% or even more, could these other major assets, the ones with serious tech behind them, actually stand on their own? Would their utility shield them, or is it more like the whole house of cards just comes tumbling down? That's what we need to figure out today.
That's exactly the core of it, yeah. Today's deep dive is really into market structure and, frankly, contagion. We kind of have to start by acknowledging the hierarchy, right? Bitcoin, just because of its sheer size, its market cap, and its role as the main entry point for big money. It's like the undisputed elder brother in this asset class.
Big boss, basically.
Pretty much. And Ether, XRP, they're like these incredibly talented younger siblings. They're pushing boundaries, smart contracts, cross-border payments, all that innovation. But the reality is they're always operating in the market under the shadow of that elder brother.
Yeah.
So today we're going to unpack that dominance and, maybe more importantly, look at the two real channels, one structural, one psychological, that let a BTC shockwave ripple through the entire market. And this happens regardless of the specific utility of the other coins.
Okay, let's start with that dominance then. In traditional finance, you sometimes hear, like, if the biggest tech firm sneezes, the smaller ones in that sector catch a cold. Shared ecosystem, supply chains, investor confidence.
Right.
But why does it seem so much more intense in crypto?
It's because in the crypto world, Bitcoin isn't just the biggest company. It functions as the anchor asset for the whole system. It really sets the tone for sentiment, for stability.
An anchor asset,
Yeah.
like holding everything else down.
For steady. Exactly. Think of the entire crypto market as like a fleet of ships. BTC is this huge, heavy anchor trying to keep the main ship steady. So when that anchor starts shaking violently, or maybe it feels like it's being dragged away, the whole fleet, the whole market, just loses its sense of direction, its certainty.
And panic sets in?
And it hits everything. It's not just the tiny, risky tokens. It impacts the big ones, too. And historically, if you look at the data, altcoins, even really established ones like ETH and XRP, show this incredibly strong correlation with Bitcoin's price moves.
Yeah, I've seen those charts. It's almost uncanny sometimes.
It is. And what's really telling, based on the sources we looked at, is how that correlation behaves when things get stressful.
How so?
Well, when the market's calm, maybe that link loosens up a tiny bit. But when there's real macro fear, some external crisis hits, or there's a big liquidity squeeze, that correlation actually tightens dramatically. It goes up.
So when things get bad, they actually move more in lockstep, not less.
Precisely. That tightening correlation, that convergence, that's the key insight here. It really confirms that during systemic fear, the market just stops differentiating based on the specific underlying tech or utility.
Oh.
It doesn't really matter in that moment that Ether has this massive active DeFi world built on it, tons of transactions, or that XRP has potential use cases with banks.
Those details just get ignored.
In a panic, largely, yes. Because the big institutional players, the ones moving serious capital, they tend to view the entire digital asset space, globally, as a single, highly correlated, risky asset class.
So it's not ETH's tech versus XRP's tech versus Bitcoin's. It's just crypto risk.
In those high-stress moments, yeah, that's often how it's treated by the big money trying to de-risk quickly. It's about the association, the basket they're all in.
Okay, that's sobering for people really invested in the tech specifics.
Mm-hmm.
So if the market lumps them together as this single risky thing, how does that fear actually mechanically translate into price drops for ETH and XRP?
Yeah.
You mentioned two channels.
Yep. Two main transmission channels, and they're pretty efficient, unfortunately. Channel 1 is the most tangible one, liquidity and market structure. This is basically the debt-driven collapse mechanism.
Debt-driven.
How? Well, think about the whole derivatives market, the leverage trading. A huge chunk of that ecosystem is built around Bitcoin. It's the primary collateral, the main trading pair.
Okay.
So when BTC prices suddenly take a massive nosedive, the trigger for the whole market domino effect is often widespread margin calls.
Margin calls.
Right.
Explain that slowly, because that sounds like where the real damage happens quickly.
It is. So you have investors who've borrowed money to bet on Bitcoin going up. They're highly leveraged. When the price crashes, the value of their Bitcoin collateral plummets.
So their loan is suddenly underwater.
Exactly. The exchange or the lending platform sends out a margin call. It's basically a demand. Your collateral isn't enough anymore. You need to deposit more money right now to cover your debt, or we sell your position.
Okay, but why does that force them to sell their other coins like ETH or XRP?
Because if they don't have spare cash, like actual fiat currency, sitting right there ready to deposit immediately, which most don't, in a panic, what's the fastest way to get the money to pay off that Bitcoin-related debt?
So whatever else they have that's liquid?
Precisely. And what are the most liquid other assets they're likely holding on that same exchange?
Ether, XRP, other big altcoins.
Bingo! They get sold off instantly, indiscriminately. Not because anything is wrong with Ether's network or XRP's utility at that moment, but simply because selling them is the quickest way to get the cash needed to satisfy the margin call on their losing Bitcoin bet.
So the assets are just dropping because they happen to be in the same digital wallet when the fire alarm goes off for Bitcoin.
That's a really good way to put it, yeah. They become the emergency cash reserve. It's a cascading sell-off driven purely by the need to cover debt elsewhere.
Wow. The market structure itself forces this cannibalization during a crisis.
It can, yes, especially with high leverage. Now, channel 2. This one is maybe broader, more psychological, and arguably more damaging in the longer run. This is the psychology channel.
Okay, what's this about?
Think about what Bitcoin represents to many people. It's the original crypto, digital gold, the standard bearer for decentralization, all right?
That's the narrative.
So if that asset, the one that's supposed to be the most secure, the most established, the most trustless, if that fails spectacularly, it doesn't just cause market fear, it causes a crisis of faith in the entire concept.
Right. People start thinking, if even Bitcoin isn't safe.
Exactly. Why should I then trust the digital silver, Ether, or the specialized banking token, XRP? If the fundamental promise of the original biggest asset is broken, the whole investment thesis for the space feels shaky.
It's like that house analogy used sometimes here. If the foundation Bitcoin has huge visible cracks appearing,
Yeah.
you don't stick around admiring the paint job on the walls, the ETH utility,
Well,
or the nice faucets XRP utility.
Right.
Your only thought is get out of the house.
That's it precisely. Get out of the house as fast as possible. Fear totally dominates rational analysis of individual projects.
So investors don't just rotate from BTC to ETH, hoping ETH is safer.
Some might try initially, but in a true systemic crisis, the big move is often out of crypto altogether. Pulling liquidity out, seeking safety in, US dollars, maybe government bonds, perhaps even physical gold, back to traditional safety.
And that creates a prolonged crypto winter for everyone.
Yeah, a deep, extended bear market. It just crushes the appetite for investing in any digital asset, no matter how good its individual technology might seem on paper.
Okay, so we know this dependency is real, it's intense. Analysts must try to quantify this, right? They don't just throw up their hands. How do professionals actually put numbers on the potential damage to, say, Ether or XRP if Bitcoin really tanks?
They do. There's a sort of standard process, usually involving about 4 steps. It moves from just defining the problem to getting a concrete risk estimate. Step 1 is pretty basic. Define the shock scenario. You need a clear trigger event. Like you might model, what happens if Bitcoin drops 50% over the next, say, 60 days? Needs to be specific.
Okay, define the disaster. Then what?
Step 2 is quantifying the dependency. This is where they use statistical tools. The most common one is the Pearson correlation coefficient.
Correlation, right. We talked about that.
Yeah. This just measures how closely historically 2 prices have moved together. So they'll calculate the correlation between, say, ETH and BTC. If that number is close to +1, it means they move almost perfectly in lockstep. That's your first red flag.
But correlation just says they move together, not how much one moves relative to the other, right?
Exactly. Which brings us to step 3, the really crucial part for estimating the price impact, using regression analysis to calculate the asset's beta relative to Bitcoin.
Beta. Okay, this term gets thrown around a lot. Break it down for us. What does beta actually tell you mathematically about how much a coin might drop?
Beta measures relative volatility or sensitivity. So if an asset has a beta of 1.0 compared to Bitcoin, it means statistically for every 1% move in Bitcoin's price, that asset is expected to move 1% in the same direction.
Okay, one-to-one movement.
Right. But here's the thing. Many major altcoins, including often Ether and others, tend to have a beta greater than 1.0 against Bitcoin, especially during volatile times.
Greater than 1, meaning?
Meaning they are more volatile than Bitcoin. Our sources often show ETH having a beta maybe around 1.1, sometimes 1.2 during shaky periods.
So let's use your shock scenario.
Yep.
BTC drops 50% if ETH's beta is 1.1.
then the simple implied drop for Ether, based purely on that beta, would be 55%. You just multiply the beta 1.1 by the Bitcoin drop, and then have 50%.
Wait a minute. So ETH doesn't just get dragged down, its fall could actually be worse than Bitcoin's in percentage terms?
That's what the beta suggests, yes. That 1.1 beta is basically the mathematical way of showing that the younger sibling asset carries more inherent volatility. It follows the leader, but often swings harder, both up and down.
Okay, that's a critical point. More potential pain.
But analysts can't just stop there at the beta calculation. This is really important. Beta assumes, like, perfect, smooth trading conditions.
Which never happens in a panic.
Never. So step 4 is crucial. Adjusting for liquidity and structural risk. You have to account for the messy reality of a market crash.
And how do they factor in that messiness? What do they look at?
The main thing is the exchange order book. That's the live list you see of buy orders and sell orders. Analysts scrutinize how thick or thin that book is.
Thick versus thin mean?
A thin order book means there are big price gaps between what buyers are willing to pay, the bids, and what sellers are asking, the asks. And maybe more importantly, there aren't many large buy orders waiting just below the current price. There's no strong floor of buyers.
Okay, so the safety net is weak.
Extremely weak. So if your beta calculation suggested, say, a 55% drop for ETH, but the order book is super thin when the selling starts, those cascading margin calls we talked about, they hit a vacuum. There are no big buyers to absorb the selling pressure.
The price just falls faster.
Falls right through those gaps. A few large sell orders, driven by forced liquidations, can push the price down way further than the beta predicted. Maybe it adds another 10%, 15% to the drop. So your 55% implied drop becomes a 65% or even 70% reality because there was simply no one there to buy.
Liquidity just evaporates.
Exactly. And you also have to consider the impact of derivatives futures, options expiring or getting liquidated, which can accelerate the crash even more. It's a non-linear effect.
That makes sense. It explains why we see these historical patterns, right? Like when Terra Luna collapsed or FTX imploded, Bitcoin drops hard, triggers this broader liquidity crunch, and then everything else just follows, often even harder. It's indiscriminate.
Absolutely. The historical precedent is pretty clear on the universality of the contagion during the acute phase. However, and this is where some nuance comes in, the way different assets might recover after the initial panic isn't necessarily identical.
Ah, okay. So maybe some difference between ETH and XRP once the dust settles a bit.
Potentially, yes. Especially regarding Ether.
Tell us about that. We know institutions tend to lump BTC and ETH together as correlated risky assets during the panic, but where might Ether find an edge later on? Does the utility finally kick in?
Well, Ether certainly isn't immune to the initial crash, let's be clear, but it's very large and active ecosystem and, thousands of decentralized apps, NFTs, all running on it, and critically, the staking mechanism introduced with its upgrades that offers a potential underlying support.
Staking, how does that help provide support?
Staking requires users to lock up significant amounts of ETH. They commit their Ether to help secure the network, and in return, they earn yield like interest.
So it takes ETH off the market.
Exactly. It creates a sort of continuous baseline demand for ETH to stake and earn yield, and it removes a chunk of the circulating supply from being immediately available to sell during a panic. It's locked up.
Okay, so that provides some structural resilience.
Yeah, it's a structural resilience tied directly to the network's function. It could potentially create a kind of support floor, meaning once the forced selling from margin calls eases off and the absolute peak panic subsides, Ether might have an inherent demand driver that helps it stabilize and potentially recover faster, fueled by actual network activity.
Interesting. A utility-based floor, potentially. Now, what about XRP? Does it face maybe a greater vulnerability in this scenario?
Well, assets like XRP, while they definitely have specific utility, particularly in the cross-border payments area they target, often face different kinds of headwinds, sometimes regulatory uncertainty, sometimes just structural differences.
It's lacking that widespread staking mechanism.
Right. Generally, they don't have that same kind of large-scale built-in yield mechanism that locks up a significant portion of the supply like Ether staking does. So in that high correlation crash scenario where, as we said, the collective loss of confidence tends to swamp specific utility cases, assets without those strong inherent lockup or yield features might find themselves disproportionately affected on the way down. They might have fewer structural buffers to cushion the fall or to kickstart an independent recovery based on network demand alone.
So the specific utility might matter less than the structural mechanics during the worst of it.
During the acute phase of a major Bitcoin-led crash, that often seems to be the case. Confidence overrides everything else temporarily.
Okay, let's try and wrap this up then. We asked the core question. If Bitcoin collapses, can Ether and XRP realistically stand firm? Based on everything we've discussed, the data, the analysis, the history, the answer seems to be
Extremely unlikely, at least not during the initial wave of panic and forced selling.
yeah, it sounds like the market is just too tightly bound together, not just by, shared exchanges and liquidity pools, but maybe even more powerfully by human emotion, fear, and these debt structures that basically force everything into one highly vulnerable basket when things go really wrong.
It's a fair summary. The whole digital asset class tends to get treated as a single target in those moments.
But as you emphasized earlier, understanding this deep dependency isn't about being pessimistic. It's practical. It means your defense strategy as an investor has to go beyond just basic diversification within crypto.
It's absolutely critical.
Like just swapping BTC for ETH isn't really diversifying away the core risk if the whole sector moves together in a crisis.
Exactly right. That's not true diversification when correlation spikes towards one. True defense requires building non-correlated buffers.
And you mentioned a few key strategies analysts recommend.
Yeah, we covered 3 main ones listeners should really consider. First, building risk buffers. This means holding assets like stablecoins, maybe tokenized gold, or other tokenized real-world assets RWAs within your portfolio, maybe even on-chain.
Why those specifically?
Because they tend to hold their value or are designed to when crypto assets are crashing. They give you that stable buying power, that liquidity, so you're not forced to sell at the bottom. You actually have capital ready to potentially buy back in at much lower prices after the crash.
Okay, maintain buying power. What was the second one?
Second, you absolutely need to monitor correlation indexes in real time. Keep an eye on how tightly ETH, XRP, or whatever you hold is tracking Bitcoin.
Why is that a warning signal?
Because if you see that correlation number climbing rapidly towards +1, that's your flashing red light. It tells you your diversification benefit within crypto is evaporating right now. That's your signal, your critical window to maybe reduce leverage, take some risk off the table, or shift into those stable buffers we just talked about.
So watch the correlation as an early warning. Makes sense. And the final strategy.
Finally, think about optimizing for resilience by rebalancing your portfolio towards yield-bearing positions. Things like staking where possible, or maybe reputable crypto lending platforms.
How does earning yield help in a crash?
Well, generating a stable, passive return, even if it seems modest compared to potential price gains in a bull market, does 2 things. First, it helps offset some of the price losses during the downturn. Second, it keeps your portfolio actively working and potentially compounding, which can significantly improve your position and recovery speed once the market eventually turns, rather than just holding static assets waiting for the tide to lift all boats again.
Right, so it's about building active defenses and not just passively holding.
Precisely. It's about adopting an aggressive defensive mindset before the crisis hits. That's really what separates portfolios that survive a systemic crash from those that get liquidated. It's proactive risk management based on understanding these deep market connections.